Hi, I'm Kep Kepner CPA here in Dallas. It's really important if you're in the real estate business to be really in the real estate business. If you're flipping a house or two, you're probably not in the real estate business. So you probably have an activity that results in a capital gain or a capital loss when you sell your property. So what if you wanted that to be an ordinary loss? Let's say you bought a house, you improved it, and you sold it for less than you had in it, and you had a loss. You might want that to be an ordinary loss. And let's say it's not that. Let's say your house is foreclosed on because it's taken you too long to get it rented and get it all renovated. So, in effect, you end up with a loss. You might want that to be an ordinary loss. Well, probably it's not. It's probably a capital loss. But let's say, in addition, that you work for a real estate development company. That was your main job. So you were in real estate more than 500 hours a year. So you were actively involved in the real estate business. Then the question comes up, okay, I'm in the real estate business. So I do most of it for my full-time employer, and then I do more real estate on the side, buying houses, renovating them, and selling them. And I did have this house foreclosed, so I want it to be an ordinary loss. Well, the tax court found that even though you were, quote, in the real estate business, the activities surrounding that house and the circumstance that said it was foreclosed upon wasn't an ordinary activity, and it was a capital loss. So the problem with an ordinary loss is I guess the benefit really is that you can deduct that against your ordinary income. The problem with a capital loss is that you have to offset the capital loss against capital gains. There are a lot of people today that may have thousands and thousands of dollars of capital losses that carried forward from the last stock crunch in 2009, when all kinds of companies lost money, their corporate stock fell in value, and the owners of that stock can only take those losses equal to the amount of gains each year plus $3,000. So I have some clients that may have a $200,000 loss, and it's going to take them years before they get to deduct it. In fact, for those people, there's a real strategy in trying to develop and find other capital gains for them, because they can have capital gains that end up in no tax to them because they have capital loss carry forward to use against it. So you really have to be careful when you're dealing with the issue of whether something is a capital loss or an ordinary loss. And in reality, in today's world, with all the hype that you're seeing in the marketplace about turning yourself into a real estate mogul, just like Rich Dad, Poor Dad, and saving by buying a house and renovating it and getting all this passive income, the reality is the kind of business it is and what you're in it for affects the kind of tax you pay. So if you need help in this area, we can certainly advise you. Give us a call. Thanks.